In 1991, regulators shut down a global bank operating across dozens of countries after uncovering one of the largest financial frauds in history. The Bank of Credit and Commerce International had built a network that handled billions in deposits, loans, and international transfers. But behind that scale, large portions of its operations were hidden through complex structures and undisclosed accounts. Funds were moved across jurisdictions in ways that made tracking ownership and risk increasingly difficult. At the same time, internal records did not fully reflect the bank's actual financial position. What appeared to be a functioning global institution was already operating with significant gaps between reported assets and reality. As scrutiny increased, evidence began to emerge that key activities were not aligned with standard banking practices. The structure that enabled rapid growth also prevented clear oversight, allowing problems to expand over time. What followed was a coordinated shutdown that revealed a system built on concealment rather than transparency.
BCCI expanded rapidly across the Middle East, Europe, and Asia, building a global banking presence in a short period of time. Instead of operating through a single, transparent structure, it used multiple entities across different jurisdictions. Ownership was layered through holding companies and offshore registrations, making it difficult to identify who controlled the bank. This structure allowed operations to continue across borders without centralized oversight. At the same time, internal controls were fragmented, with no single authority able to verify all transactions. Early signs of irregular activity appeared as funds were moved between entities without clear documentation. These movements were not isolated, but part of a system that allowed transactions to pass without full visibility. By this stage, the bank's structure was already limiting the ability of regulators and internal systems to understand its true position. As operations expanded, BCCI began handling transactions that did not follow standard banking controls or verification processes. Funds were transferred across accounts and jurisdictions in ways that obscured their origin and final destination. Some transactions were structured to avoid regulatory scrutiny, making it difficult for authorities to trace ownership. At the same time, accounts were opened and managed with limited documentation, increasing the risk of misuse. These practices allowed the bank to process large volumes of funds without clear transparency. Internally, records did not fully align with actual movements, creating gaps between reported data and real activity. What appeared to be legitimate banking operations increasingly included transactions that could not be clearly explained. By this stage, the system was no longer just complex, it was enabling activity that could not be fully accounted for. As these practices continued, losses and irregular balances began accumulating across different parts of the organization. Instead of being disclosed, these gaps were managed internally through adjustments that masked the true financial position. Funds were moved between entities to cover shortfalls, creating the appearance of stability across the system. This process allowed the bank to continue operating while underlying problems expanded. At the same time, external reporting did not reflect the full extent of these internal adjustments. The complexity of the structure made it difficult for regulators to connect activities across jurisdictions. What appeared to be isolated issues were actually linked through a system that redistributed risk without resolving it. By this point, the bank was operating with a structure that depended on concealment to maintain its position.
As investigations intensified across multiple countries, regulators began identifying inconsistencies in BCCI's reporting. Information requests exposed gaps between declared assets and actual financial positions. Different jurisdictions uncovered conflicting records, making it clear that the system was not unified or transparent. At the same time, internal controls were unable to produce a consistent account of the bank's activities. Funds that were reported in one location could not be fully verified in another. This increased pressure on the bank to explain transactions that did not align across its structure. Confidence began to decline as counterparties questioned the reliability of the institution. What had been concealed within complexity was now being forced into view under regulatory scrutiny. As inconsistencies widened, regulators uncovered that reported assets did not match the bank's actual financial position. Large portions of the balance sheet could not be verified, revealing gaps that could not be explained through normal operations. At the same time, internal records failed to reconcile across jurisdictions, confirming that the structure itself prevented clarity. Attempts to stabilize the situation were no longer viable as trust among regulators and counterparties broke down. Transactions that once passed through the system were now being blocked or questioned. Without confidence, the bank could not continue operating at a global scale. The structure that had enabled growth was now preventing recovery or correction. At this point, the collapse was no longer avoidable, as the system could not support itself under scrutiny. In 1991, regulators across multiple countries moved simultaneously to shut down BCCI's operations. Accounts were frozen, branches were closed, and access to funds was immediately restricted. As authorities took control, the true scale of the financial gap became clearer. Billions in assets could not be located or verified against reported balances. Because operations were spread across jurisdictions, unwinding the system became complex and time-consuming. Depositors and counterparties were left exposed as access to funds was disrupted. The bank's structure, which had once enabled growth, now made resolution more difficult. What followed was not a gradual failure, but a coordinated shutdown of a system that could no longer operate. By the end of the shutdown, losses associated with BCCI were estimated at over $10 billion, affecting depositors and institutions worldwide. The collapse became one of the largest banking fraud cases of its time, spanning multiple countries and regulatory systems. Investigations continued for years, revealing how the bank had operated outside standard financial controls. The event exposed weaknesses in global banking oversight, particularly across jurisdictions. What had appeared to be a large international institution was found to be a network that lacked transparency at its core. The structure that enabled secrecy also prevented early detection of risk. For many affected parties, recovery of funds was limited and prolonged. The outcome reshaped how regulators approached cross-border banking and financial supervision.